Welcome to this explainer. Today we're diving deep into Public Service Enterprise Group, or PSEG. We're going to unpack their strategy of predictable utility growth and smart infrastructure investment. If you've been looking for a solid case study on how a legacy utility actually manages to balance massive capital expenditures with incredibly consistent shareholder returns, well, you're absolutely in the right place. Let's get right into their thesis of steady, regulated growth.
Here's our roadmap for today's explainer. We'll start with how PSG powers New Jersey, then we'll break down the financials, look at their infrastructure investments, and explore how they balance cost with reliability. After that, we'll touch on corporate governance, and finally wrap up with their dividends and future outlook.
All right, Part 1, PSEG, powering New Jersey.
So PSEG is New Jersey's oldest and largest public utility. They deliver gas and electric to a whopping 74% of the state's population. To really put that footprint into perspective, we're talking about 2.4 million electric customers and 1.9 million gas customers spread across a 2,600 square mile territory. But it's not just about the wires and pipes. They also operate a massive 3,758 megawatt carbon-free nuclear fleet out in New Jersey and Pennsylvania. That specific combination, reliable regulated delivery paired with carbon-free generation, that is literally the bedrock of their entire business model.
Moving on to Part 2. Breaking down the financials.
Now, before we actually look at the numbers, we really need to understand a specific metric that PSG uses a lot: non-GAAP operating earnings. As you guys know, when you're dealing with nuclear fleets and these massive energy portfolios, standard accounting can get, well, incredibly noisy. This non-GAAP metric strips out all those volatile elements, like those wild market swings in their nuclear decommissioning trust funds, or mark-to-market accounting adjustments. By backing out those paper gains and losses, we get a much clearer, truer picture of the company's everyday operational health.
And this completely illustrates why that matters. Just look at the top line. Standard GAAP net income surged to $741 million, or $1.48 per share, in Q1 2026. That's a massive jump from $589 million the year prior, right? But when we look at their non-GAAP operating earnings, we actually see a much smoother, highly reliable view. Operating earnings came in at $778 million, or $1.55 per share, up from $1.43 the previous year. It shows us that solid, foundational growth without all the distraction of market volatility.
Plus, that strong earnings performance translated directly into some seriously excellent liquidity. If you look at the cash flowing into the business from daily ops, it jumped from just over $1 billion in the first quarter of last year to a very robust $1.27 billion in Q1 2026. And listen, this cash generation is absolutely the lifeblood of a utility company, because, as we're about to see, they need a ton of capital to maintain and upgrade these networks.
Which brings us to Part 3. Investing in infrastructure.
Okay, PSEG has announced a staggering total capital program of $24 to $28 billion targeted for the 2026 through 2030 period. Just take a second to think about the sheer magnitude of that number: $24 to $28 billion. That is a massive structural injection of capital aimed directly at modernizing and securing the energy grid of the future. So let's break down where all that cash is actually going. Over 90% of it is earmarked for regulated investments. That means the spending is structurally protected by regulatory agreements, which gives us super high visibility for returns. They're focusing largely on replacing aging systems, bolstering transmission lines, and advancing clean energy initiatives. But here's the kicker, and it's probably the most important point here. They plan to fund this entire 5-year sprint using just their strong balance sheet. Yep, no need to issue new equity or sell off assets. Zero shareholder dilution, which is huge.
The crucial takeaway here is how efficiently this massive investment translates into actual earnings growth. When utilities invest in approved, regulated infrastructure, their quote-unquote rate base grows. And PSG is projecting a rate base compound annual growth rate of 6 to 7.5% all the way through 2030. This is the literal engine of their predictable growth. You invest in the grid, you grow the rate base, and you predictably grow earnings. It's that simple.
Let's jump into Part 4, balancing cost and reliability.
You might be wondering, how do these massive investments actually impact the everyday consumer and system health? Utilities are constantly walking this crazy tightrope between upgrading their systems and keeping customer bills affordable. Amazingly, PSGE manages to thread the needle perfectly here. They deliver the highest customer reliability and the highest overall residential customer satisfaction among their peers. But at the same time, their distribution operations and maintenance spend per customer is actually the lowest. They are highly, highly efficient. Now, the one area requiring intense capital focus right now is their gas network, where they do have more leaks per mile than peers, mainly due to an aging cast iron system. But they've got their Gas System Modernization Program, or GSMP, aggressively targeting this specific issue to bring that gas infrastructure right up to the gold standard of their electric grid.
Next up, Part 5, Corporate Governance and Compensation.
At their 2025 annual meeting, an incredibly impressive 93.8% of stockholders voted in favor of their say-on-pay proposal. Now, if you follow corporate governance, you know that anything above 90% signals overwhelming investor confidence. It clearly shows that shareholders truly believe the executive team's compensation is perfectly aligned with the company's performance and long-term strategy.
And it's pretty easy to see why shareholders are so supportive. PSEG's governance framework is a very clear dichotomy. Look at the what we do side. They tightly link pay to performance, they embed sustainability metrics right into compensation, and they set disclosed stretch goals. Then on the what we don't do side, they strictly forbid guaranteed incentive compensation, no excessive perks, and they absolutely do not use plans that encourage executives to take crazy, excessive risks. It is a textbook example of responsible corporate governance, designed specifically to protect the long-term health of the utility.
Finally, let's hit Part 6, Dividends and Future Outlook. PSEG boasts an unbelievable track record of paying a common dividend to its shareholders for 119 consecutive years. I mean, just let that sink in for a second. 119 years. Through world wars, economic depressions, and massive technological shifts in the energy sector, they have consistently returned cash to their shareholders for well over a century. That is some serious staying power.
And building on that century-long legacy, they remain totally focused on the future. They actually just raised their indicative 2026 annual dividend by roughly 6% to $2.68 per share. This marks their 15th consecutive annual dividend increase. So how are they so confident in this payout? Well, because they have an unmatched track record of 21 consecutive years meeting or beating their operating earnings guidance. 21 years. Looking ahead, they are projecting a non-GAAP operating earnings growth outlook of 6 to 8% annually from 2026 straight through 2030.
So when you look at their unmatched history, their pristine governance, and those highly structured, non-dilutive infrastructure plans, we're going to leave you with this final thought. With a 6 to 7.5% expected rate-based growth locked in for the rest of the decade, is PSG's predictable power enough to energize your portfolio? Thanks so much for joining us on this explainer, and keep learning.